All right, welcome. Money Club Mondays, January 10th, 2022. Can you believe it's 2022? Still getting used to that, but welcome and thanks for being here. So today we have a special guest, Mr. Kevin Shortel with us, who is one of the top note investors in the United States of America. He's been working with us in the money school and our clients now for a couple of years. I've known Kevin for a couple of years before that, and he does an incredible job. So I asked Kevin to come on today just to talk with everybody a little bit about, what notes are, different ways to get involved with purchasing notes. Kevin, I'll let you take it away and do an intro here in just a second. But Kevin comes on almost all of our 3-day trainings, which, by the way, Kevin, are you on the one that we're doing in a couple of weeks?
Yes.
Okay, perfect. So this will be a great preview too, because during the training, Kevin really gets into a little more detail and really teaches, a little bit more in depth about what notes are. So if you like what he's talking about here today, you'll definitely want to join us for the 3-day training coming up January 22nd, 23rd, and 24th. Just let me know and I can give you a really good little discount to get into that too, if anybody wants to join us for that weekend. And then Kevin is also in the Private Money Club. So we will talk more about that as we go in here today, but kind of show you the differences and how you can get involved investing in notes, whether those are buying those direct or whether that's learning how to do it yourself and going out there and finding them yourself. Kind of like the difference we talk about a lot with, active versus passive investing. So today, think to yourself, are you want to be an active notes investor or more of a passive notes investor? And we can kind of teach you how to do both those things. So Kevin, how's it going?
It's going great. And while you were watching football, I had about 150 notes to go through to sift through to find the good ones there. But now that really only takes me about 30, 40 minutes, to go through that many for me. But I got all the football in too. So.
It's funny you say that because I wrote, when I saw the Bills got in yesterday, I text Chris in our little group text that we have with Gabby and Hannah and Shauna and Andrew and everybody on. A lot of them are Bills fans. And I said, "Go Bills, congratulations." And Chris was like, "Oh, we won. There was a football game." Chris doesn't follow football, but kind of jokingly, being from Buffalo, he loves it. But he's like, "Yeah, I just watched this video that Ray Dalio put out." He said, "I watched it 4 times, made detailed notes and put together a 3-segment training on the topic alone." I'm like, wow, that was a much more productive Sunday than I had. But that's why Chris is at the level that he's at. That's why, Kevin, you're at the level you're at, and you guys are such an inspiration. And that's why you're my mentor. So I love it.
Awesome. Well, I've got some really good stuff for you today. It's the first one of the year, I think, that you're doing. And I'm going to share with you all something that I've only shared with my private clients so far. And it's something that I've been preparing them for the last probably 2 to 3 months. And something I've been tracking really as long as a year, just thinking it was going to happen. It finally did about 3 months ago. So I've been sharing that privately, but I think it's time to open it up to your folks because I tell you, I'm working with a number of people that started, with you and Chris, and they're doing great. They're loving the program. They're investing. I talk with many of them on a regular basis and just fit right in. So everything's going really well on that end of things. I will also, everybody, keep it fairly simple too, because I know we have new people coming in all the time, and I'm not really a kind of instructor teacher that just has a canned presentation that I do all the time. I always like to mix it up. Not saying I won't use some of the same examples from time to time, but I like to keep it new. I like to keep it fresh. And this is certainly one of those. So make sure you stay towards the end, because the way I built this is leading up to this new technique that I want to show you guys, which is a complete game changer. The last time they had something like this, the amounts of returns that you can get are just unbelievable. So I guarantee you'll be pretty stunned on what's happening out in the business that I'm pretty darn excited about. But let's go ahead and start with the basics again here. Let me share my screen to make sure that we have everybody on the same page. Let's see if I can do that. Share. There we go. Okay, you can see my screen, right?
Yes.
Okay, perfect. That full size. There we are. All right. So for those of you not familiar with me, you can look that up a little bit later if you choose to. But as Stephen was saying, I've been in this industry for over 36 years now, and I've been educator of the year for many years and written bestsellers. everything else in the business. So I'm highly involved in it. You can find me on my website or Google or YouTube or wherever. I'm not that difficult to find if you want to look into that. My book's up on Amazon there as well. So we're going to focus on investing in real estate backed notes. And investing in real estate backed notes is different in investing just in properties that most people are familiar with. Most people get involved in real estate, see real property. But real estate really also includes real property and the financing side of things. I'm in the financing side of the business. That's what investing in real estate backed notes is all about. We don't go out to buy the property. We buy the debt on the property that the person has to pay back. And that's the simplest way that I can explain it. So while most investors buy properties, some are flippers, right? Some are buy properties and turn around and rent them, long-term investors, that sort of thing. And what we do is really just look at the property as our collateral. It's what backs the loan. So essentially, we're buying loans that somebody else has already created. Now, we can also create our own loans, but for the most part, we're buying loans that somebody else has already created. So we're evaluating the present value of that loan. And we are looking at the real estate because the real estate backs that loan. In other words, if they don't pay us on the loan, then the property is our collateral that we can pursue one way or another. So the big difference there with note investors and property investors is you go after the property directly to build that equity, or on the debt side of things where the property is simply the collateral for the note. Now, the collateral is secured. So when we buy notes, everybody calls it the note business, but technically we don't just buy notes. I mean, a note is just a promissory note. Somebody is borrowing money, promising to pay it back. Well, we want some more security in the lending business and real estate, just like a bank would. So a bank says, yeah, we'll give you the money, and it's great that you promise to pay it back in writing, but we also want a security agreement, normally in the form of a mortgage, but there's a variety of them, normally in the form of a mortgage that acts as that security agreement, essentially, again, saying if you don't pay, then you're putting that collateral at risk. And we can get that collateral back either voluntarily through things like a deed in lieu. Some of you have heard of cash for keys deed in lieu. You maybe have already done that before, or we have to foreclose on a property like any lender would do. The other benefits and the other differences from more traditional real estate is we're just getting the cash flow just like a bank on a monthly basis. But the people living in the property are not our tenants. Right? So we don't have tenants, we don't have property management, we don't have the maintenance, we don't have all of the headaches that come with property management. We don't have any of that because we don't own the property. The borrower living in the house owns the property. We just own the debt on the property that that person is paying back. And by the way, for those of you with IRAs and 401ks, all those things, these are approved investments, meaning you can have money in normally self-directed IRAs and 401ks, which I know Chris and Stephen go into, but you can use those to invest into these and then have all of your financial gain being not tax deferred or tax free, depending upon how you set those items up. So a big shift here. And a lot of times what happens is I do have many clients that were very seasoned real estate investors on either the flip side or the long-term side. And they kind of reach a point where it's like, man, the properties are so expensive right now and people are overpaying for things and it's harder and harder for me to find deals, or they've got tenants that they've been dealing with. They even have management companies, but the management company's calling them all the time. They're like, boy, I really would like just to step away from that and get the cash flow. That's what this industry is all about. So the way it works with us, even more hands-off, is we have a servicing company, which really is the conduit between you, the note owner, and the borrower. So they collect the money. If the person's monthly payment includes taxes and insurance, that money will be held in escrow and paid when it's supposed to be paid. If the person is late, servicing company sends out the late notices, et cetera, down the line. So most everything we do, we outsource the servicing, although you could self-service, but for the most part, you're going to find that you want to outsource all of the servicing and let them deal with the borrower. So it's really on the performing side of things, all about building up passive income portfolios. And it is on a monthly basis in virtually every loan. I mean, there's some types of loans that people might pay once a year or quarterly, but virtually 95% or more of the loans that you'll be looking at purchasing for those who pursue this are going to be monthly based loans. So that's the basis of the foundational knowledge of where we are. It all evolves around these two instruments here, the note and the mortgage. And then, as you would imagine, there's various degrees, just like there's different degrees of real property. You can pay retail prices for a retail property. That's, anybody can do that. Where do you make your money buying real estate? Well, you're looking for properties that can use some work, and you can build the value into the properties that way. So in our industry, we have performing notes, and performing notes are obviously notes where people are actively making those monthly payments. And then the length of time they're doing that is called seasoning in the business. It's a payment history. And we also have on the other side, non-performing notes, where people are not actively making their payments on a timely basis. And you have somewhere in between there, you have what we call sub-performing notes, where somebody might miss a couple of months and then catch up as a regular pattern, or they make some part of the payment every month and then eventually catch up. So there's varying degrees within this. And as you would imagine, you're paying less of a price. You're getting a greater discount. If I flip that around, you're getting a greater discounts on notes that are non-performing versus performing. Okay, and that's one of the things that we look at. However, having said that, in today's world with how the inventory exists and the maturity really of the industry over 30 years has been incredible, because it is now recognized as its own asset class. It's always been, but it's been very low profile. Real estate and this note kind of thing is what it was often referred to. And now it's been elevated because more and more investors have been attracted to that. There's a better understanding of it. There's people like myself that have been educating people for years on this. And that's changed the game, because not only do we have inventory available all year round, every year, every business cycle, we're starting to see more of that built in the legislation. Because of the last crash, the Dodd-Frank Act recognized that the government really couldn't solve the problem, no matter how much money they sent to it. And then Wall Street tried to figure it out. They couldn't do it. It really came down to individual investors, and that was really built into the system now. So the good news is we have inventory at all levels, performing, not performing all the time, but we will see fluctuations within that inventory. And I'm going to touch on that towards the end, because I'm not only going to show you this technique that we've been prepping for two months, but also why it's going to be there for you. All right, so let's focus just for a minute on performing notes. Most of the clients that have come in, especially from the money school, were interested in passive income. It's one of the big things. So for the most part, they start at least with performing notes. And performing notes on the surface can be very, very simple. So this is a typical deal. I think this sold sometime mid last year. One of my clients purchased this. It's a $38,000 property in Springfield, Illinois. Now, I know we also have people from throughout the United States, and you're looking at, you can't get anything $38,000 here in my area. That's why in the note business, we go to where the deals are. I know in more traditional real estate, it's always location, 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 know your backyard sort of thing. We think more like bankers, and we go to where the deals are. And there's a lot more deals in affordable housing areas for us. And I could go on for reasons, for another 20 minutes, but just understand that in this business, we have a tendency to look at the Midwest and the Southeast for the bulk of our inventory, where you're going to find deals like this. You have less competition, you have more diversification, you have lower risk, and you have higher yields. Why would you want to go somewhere else where you have the opposite of that? Okay, that's what it really comes down to. So a typical deal here, and this is a great area. Illinois is a big state for this. $25,500 purchase price. And what this investor, what she was buying in return for $22,500 today was 163 payments of $344.59 per month, which comes out to a 16% annualized return. right? She's investing the money now. It's kicking back passive cash flow for 163 years. She's making a 16% return on her money. Now, I've used this example before. It might even be in one of the videos. I saw you had a video up of me on your site there, Stephen. But what changed about this deal, by the way, her yield went even higher. And it went even higher because what she did was she sold a partial on this note. I can't remember how many payments or anything. I'll say 80. I'll just say about half of the note. She turned around, and because this income stream represents monthly payments into time, right, into the future, it looks better that way, she can sell off any portion of those payments if she chooses to. And that's what she did. So she sold off about 80 payments of this loan, kept the back half of the loan, but she sold off the next 80 payments to another investor, and she recouped all of her investment money plus a return. So she's made an outstanding yield. She'll start getting that cash flow back once this investor receives their next payment. In the meantime, she takes that money and does what? Buys another one. Okay, it's a little technique that I teach there. So kind of an interesting way this played out. This is a fairly recent one. This closed in November. This is in Florida. This property was a foreclosure. One of the other ways that we get our inventory is from more traditional real estate investors that are still buying foreclosures, and then they turn around, they fix it up, and they sell it. But the quickest way to sell it, and very necessary way in some areas to sell it, is to offer financing to people. And then they know that there's people like me that will buy that financing once they create it. So this started as a real estate investor who bought this property at a foreclosure sale here on the west coast of Florida, purchased the property, and then sold it as is with seller financing for $45,000. The gentleman who bought this, by the way, converted this to an office space. So the zoning's been upgraded there. He uses it as an office for his business, and his business is doing really well. I mean, the internet's an amazing thing, right? We can get online, we can search, we looked at his business, we saw that he was marketing, we saw that he's doing great. We're going, this is going to be a good one. So the way this was structured, the buyer of this property put $15,000 down. Now think about that. You're buying this property for $45,000 in total, and you're putting $15,000 down. Is that a good down payment? Of course. They've got what we all say, skin in the game, right? They have every intent to pay that back. That's hard money to walk away from. They're going to make their payment. So there are things like that that we look at when we're evaluating these notes out. You know, what's working towards the value, what's working against the value of the note, and certainly a large down payment like that absolutely helps. Do we look at all the paperwork? You bet. And there it is. That is the actual statement there showing the $15,000 down payment on this deal, all the other terms, how the taxes and everything. And we go through all of this before you buy the note, before you commit any money to buy this note. We go through all of this documentation here. So you can see that the mortgage note then was for only $30,000. Okay. 45,000 sale, 15,000 down, leaves you with 30,000. And they've got all the terms over here of when these notes, when the payments are due, what the interest rate is, et cetera, et cetera. And this one had a little different twist that you do run into from time to time, where they based it on monthly payments for a period of time, let's see, of 2 years, you can see there, make payments for 2 years, and then the entire principal balance at that time is due in a lump sum. That's called a balloon payment. So we went through this one, my client and I together to examine this, and what a great deal. Oh yeah, I'll mention that in a minute. What a great deal this turned out to be. This was a self-service note. So the investor who did this didn't use the third-party servicer. In fact, they were collecting the payments through PayPal. I really don't care. I want to see did they make the payment? And did they make it on time? And the guy just went on PayPal and printed out the form. Like, great, there's your payment history. That's all I need to see there. So the payments on this one are $424 a month. There was 36 months, 36 months with a balloon on this note. So the gentleman who sold the real estate and now is collecting the payments, collected a number of payments. In fact, when he sold this note, there were only 14 payments left of the original 36. plus the balloon of $20,915. So we went through, we ran the math to come up with an offer on this, which was accepted, and it was just under $20,000. So this investor invested $20,000, is going to collect 14 payments of $424, and then a balloon of $20,950. Now, I know some of you are probably thinking, what if they don't pay the balloon? We think of all of those exit strategies, right? We look at all of those scenarios. If they don't pay the balloon, what can they do? Well, they can accelerate the loan. They could start foreclosure. Nobody wants to do that if you're receiving income from it. Instead, if they don't come up with the money for the balloon, we'll just kick it back another year, right? And readjust that. And when you readjust the loan, can you charge a little bit of a premium to work out some kind of agreement? Of course. So we absolutely think about the best case scenarios and worst case scenarios. And the fact of the matter on this one, with everything that we've seen, the down payment, the payments come in on the first of the month, every single month. They have for the whole time. The guy's business is going great. This one's going to be no problem. It'll probably get the balloon. Okay. If he doesn't, again, all kinds of techniques for that. So just closed on that one in November. I still have to show this one. I think I showed this one before, but James is part of the Money Club, and he saw one of my postings on Slack, and that's for the Private Money Club, right?
Yeah, right. So
Yeah.
Slack was, just for everybody knows, Slack was what we were using before.
Yeah.
We're slowly migrating everything to privatemoneyclub.com now, but we're still getting some stuff on Slack. So yeah.
Yeah. So James out in LA, and he saw that one on Slack and said, I like it, I want it, and need some help with it and everything. He got set up with me and became a client of mine and closed on this within 2 weeks. So people who are looking to move fast, that's the fastest one so far. And that's why I'm showing this one, because it can happen that quick. Not everybody wants to go that fast, by the way. I have other people that have come on board and just said, I'm going through your materials, I'm studying, I'm learning, not quite ready yet. But he was ready to go. He got it. He got into this. I think he's purchased 4 notes at this point in time and doing really, really well. But again, this one was almost one of those, you didn't have to think that hard about it. The people who living in this home have been there for 10 years. Okay, the house is worth $64,000. So the payment history was there. The longevity of the payment history was there. The property value was there as it relates to what his investment was. And he's making an 11% return secured by a $64,000 property. Again, went through all the documentation of everything, the original loans, any assignments of the loans. We go through the title reports, BPOs, all those sorts of things before you commit any money. To get those things done, and reviewed everything. Sale went through, and so he got involved in that one at
Kevin, James 11%. Is in LA. James is out in LA. Where's that property located though?
This property is in let's see if Indiana.
Okay, right.
Yeah, it's in
Walton, so we're just asking in LA. Yeah, there's not a lot of $64,000 homes in LA.
Yeah, that's what I tried to say earlier. I don't have anybody really in California buying California notes. I've got a couple. Christine, she's looking for stuff in California, lives out there. But what she's found is they're not as good a deal. A lot of times in higher priced areas, you're competing still with some of the mid-level hedge funds who typically have more money than you and are willing to buy within portfolios and such. And it can be more difficult in other areas. And in this business, you go to where the deals are, because at the end of the day, I know the comfort factor for most people as well. I want to be able to see it, drive by it. That goes out the window real fast once you start to learn this business, because you don't think anymore with that mentality. You think of, if I do have to have boots on the ground, if I do have to take this property back, because I think he paid maybe 30 for this. I can't recall it, and I don't have it on the slide for some reason. Right. But you've got a house that's worth twice as much as what your investment was. So if things did go bad, because again, we have to think of that scenario. Well, he's got something that's worth twice as much money. So you either get that property back, you do some kind of renovation on the loan, if you will, meaning you do some kind of workout on the loan and get it paying again. Why does it matter where that's located? And that's more of the bank mentality that you have there. In California, you might be looking at putting a heck of a lot more money out and making a lower return. Why not take that money and buy 3 or 4 notes in other areas where you're getting safer deals, higher returns?
One of the cool things about this, that's what I love about notes, private lending. I mean, and we talk a lot about mortgages, promissory notes, and things like that on these trainings. So I think a lot of people are kind of familiar when you're showing these, notes and mortgages. Like we've gone through a lot of that and have talked about it. So it's cool. It all kind of comes together, like if you're doing the private lending, this is a great, add-on to for additional investments to moving the money, because you're already familiar with what to look for and how to read them and the language in them and stuff like that. And then the fact that they're all over the country, it just opens up your options.
Yeah, and private lending is the note business. I mean,
Right.
private lending is a part of the note business. The note business, like I said, we can originate loans. We can buy loans as soon as they're created. We can buy loans that are seasoned. We can buy loans that are not being paid on. It's all the same thing. I used to be a hard money lender here in Florida. And what I got tired of doing was, now this goes back before the last crash, you could see that people were overpaying and they were fighting on deals, and it was getting thin. And I get nervous about putting money out there, knowing that this thing could crash at any point in time. And it's not a big step. I ended up going back to buying existing notes from where I came from instead of lending money, because then I could look at that history, look at the payments, look at the properties, and because property value is still going up. And I said, great, I'll just jump back into that. And it's not, you're right, it's not a hard transition for a private lender. The big difference is you have to know how to go back and investigate these things to see all the paperwork. A lot of lenders are used to, they create their own paperwork. That's what they know. Perfect. And I get that. You can cookie cut that. When you start looking at these, you might have a land contract, you might have a deed of trust, you might have a security, a deed that's written there. Somebody might have sold that note 3 or 4 different times, and we have to track allonges and assignments and things like that. So that's where the new skill, would be added on to what you currently have. But yeah, it's really the same. It's in the same family. So you're in the note business there. Let me switch my attention to non-performing notes here. Okay. And I'm going to do a little bit of the stats for you, because I think it's important to show you why I've been talking about this with my clients for a couple of months and really not sharing it with the general population through my YouTube or LinkedIn and all that stuff. I'm not putting that out there. I'm keeping that closer to the vest, but I'm going to share it with your group. And this is documentation that comes together from a company in Jacksonville, Florida called Black Knight. Black Knight Financial Services has been tracking this stuff for years and years and years, and they put these monthly mortgage monitor reports out. Now, the data they report on, this report just came out in October, and it's reporting on August, but that's the latest data that's currently available. So it's always a little bit behind. We're always taking a look back at what happened. But it's really good data that you can start to track, as I had over time. So I'm not going to go through all the tracking with you, but I want to point this out to you. The fluctuation that I was talking about that we're going to have in the industry, the expectation that we're going to see more subperforming notes is very real. Now, initially, there were 7.1 million people that, because of COVID, didn't have to make their mortgage payments anymore, right? There was these forbearance plans that were created. The can got kicked down the road. It went from a 6-month program to a 12, to an 18, to a 24, and then another 6 months after that. And quite frankly, the plan has worked for the majority of people. So overall, if the measurement is, did it help 5 million people stay in their home and avoid foreclosure? The answer is, we're about 4 million. So yes, it did. Okay. There's another 2.1 that are still in plans, but don't show a high probability that once these plans expire, which they are going to do, then are they going to be able to afford their payments? And if they're not, we have another big foreclosure problem in our country. And once again, the government's going to step in and probably set a plan up. And that's what I've been thinking all of last year and before, because they've done it in the past. I've been around long enough to see that happen in 2009. So I had every expectation that the government's going to have to address this, because I don't care who's in office. They don't want to have 2 million people in foreclosure. Right. Okay, let's face it, right? So this is about, this is where we are as of October here. So you can see it's starting to balance out here. We've got about $64 billion worth of loans here that are past due, which translates to about 2.1 million notes. that's further verified. Ton of information here. I know, I apologize, but I just want to show you some of the stuff that I go through. I'm going to narrow it down to these numbers. 2.1 million, that's where I got it from. That's the total loans that are not being paid right now, okay? And out of that, you've got 138 that are in foreclosure. And by the way, nationwide, foreclosure starts in October, 3,972. I like to point that out because I know a lot of people are real estate investors and they're looking for inventory. This is one of the reasons you don't see inventory like you used to. The Dodd-Frank Act has made it much easier for banks to bundle up their loans and sell them when they go bad, rather than go through the timely and expensive process of foreclosure. I mean, you can go back all the way to January of this year. There were only 5,800 foreclosures that month. The next month, 3,800. There hasn't been, I think there was maybe one month maybe that there was over 6,000 foreclosures started in the US here. And I think that was in August, but it's been under 3,000. So when you're looking at price, when you're looking at opportunity, do you want to be where there's only 138,000 foreclosures nationwide and trying to find deals in that pond? Or do you want to go where there's about 2 million people that are going to be struggling with loans that we know is coming down the pipeline? In my mind, that's an easy thing to understand and to look at. You know, when you're fighting over too few deals, the prices are going to go up. You're taking on way too much risk. Very briefly, the banks are motivated not to foreclose through Dodd-Frank because of the penalties. When a note goes bad, depending upon the percentage of notes that go bad, bank can be put under penalties of 10% of 10 times. So if they've got $1 million, just to use a small number, $1 million, we can wrap our head around $1 million worth of non-performing notes. The balance is there's $1 million. They have to have 10 million of that in cash reserves. So if they've got $20 million in loans that are not performing, that's the balances on those loans, they have to put 10 times that aside that they can't loan. So the motivation is get them the heck off of our books. How do they get them off the books? Not through foreclosure, because that takes time. They bundle them up and they package them and sell them. And you can look up Fannie Mae non-performing loan sales and you'll see probably we're at 11, 12 billion last year that they sold. Right. And that's how it works. So there is a new background in this. Now, when it comes to non-performing loans, we're going to see them. And how you play those out really, again, depends upon that individual deal. We prepare for everything. Are we going to get this property back? Or are we going to be able to do a loan resolution? Are we going to get a deed in lieu? Are we going to get a foreclosure? What's more likely to happen? And this one just closed on in December, around December 15th. This one's up in Indiana as well. $40,000 is the property value. They owe 50. So you do still see some people who haven't made payments in a long time. And what happens when people don't make a payment in a long time is their unpaid balance eventually gets put on a hold, and then they start building up this arrearage account as well. And a lot of people aren't paying taxes and insurance also, which we have to look at on there. So $40,000 is what the house is now worth. The unpaid balance with penalties and such was $50,000. And it's in the final phase of foreclosure. And that's another trend, Stephen, that I haven't really seen before in our industry, where people are taking these things down the road of foreclosure and selling them before the actual sale, which is really kind of interesting. And if you are educated enough to go through and understand where that is, it can be an amazing opportunity. Because what a lot of people don't realize is there's something called an assignment of foreclosure position. And that's available in every state in the United States. It happens every single day. Why? Because Fannie Mae uses it. Okay, so the federal government uses that technique of an assignment of foreclosure position. So in this particular deal, knowing it was a non-performing loan, the person had been made a payment in close to 3 years. The original note owner, I think, bought this and got a little frustrated, maybe didn't know what they were getting into and was just wanting to get rid of it. They took it all the way through the foreclosure sale. In fact, by the time my client bought it, the foreclosure sale was scheduled for December. I think it was around the 15th. So it was going that direction, and he got an assignment of foreclosure position. And I said, you have to get that in writing before you get this. So very interesting. At the foreclosure sale, he gets to set his strike price. So he invested $15,000 in that note. $15,000 investment backed by a house worth $40,000. That's scheduled for a foreclosure sale in less than 30 days. That's how he bought it. Okay. So once it went through or getting to the sale, at the sale, he can set his strike price up to $50,000, but doesn't have to be. So he can take what's the unpaid balance, what's the arrearage account, what's the back taxes, interest, and even legal costs, and set that as his price at the sale. Now, he's not going to the sale. He doesn't live in Indiana either. So that's what the attorneys are doing. They send a representative to the sale. And what he tried to do was to get cashed out at the foreclosure sale. So instead of setting the price at $50,000, where nobody was going to bid, let's face it, the house is worth 40. Nobody's going to bid 50 if the house is worth 40. If he did that, he'd get the property back. Almost 100% guarantee, right?
So if he wanted the property, like if he was a real estate flipper, then he would set it high because he'd get the property.
Exactly. Because then he'd get the property back and then turn around and sell it with seller finance or what have you. Or if somebody's really dumb and bids more than 50, he gets cashed out, But yeah, let's face it, he would get the property back if he wanted to in this case. And he thought about it. We ran through all the different scenarios. He bought this with his IRA. So he said, yeah, you know what? Instead of my IRA having to put more money to fix it, I think I'm going to try to go ahead and get cashed out at the sale. So he set it, I think, at $25,000, something like that. But there was only 2 foreclosures in this whole county. This is the middle of Indiana, in the middle of nowhere. So the property didn't sell at the foreclosure. There was essentially nobody at the foreclosure sale. So he took the property back. But what I had told him before it even got to the foreclosure, I said, start prepping this. Start getting online and finding real estate investors out in the area who may want to buy it, and they'll either buy it at the sale or you can sell it to them after the sale, all that sort of stuff. So he ended up getting the property back. And now he's got those same 2 investors are really interested in buying the property at this point in time. So once again, you could be creative. He could sell it to them for cash. You can see what his bottom line is. $15,000 plus his attorney cost was, I think, another $2,000 on that. So you can see where his starting price is, or he could do what? Sell it to a rehabber with financing, right? Do a short-term loan like that, because he owns the home free and clear, right? All the loans all went away. He bought the loan for $15,000 to get the property back. Or I said you could finance it for somebody, or maybe do a joint venture where they've got the time and money to fix it, right? And then you guys turn around and sell it together and split the equity. There's all kinds of scenarios that you can do on these. But it does show you, though, you have to be a little bit more active on the non-performing side. And that's another point, because on the performing side, much more passive. You're buying something that's working, you're getting it at a discount, you're getting good yields on that. On these, you do have to steer the boat a little bit. You're not doing the work, the attorneys are, but you got to stay on top of them. You got to make sure you got the documentation done. You got to make sure this is being done, setting the strike prices, all that sort of stuff. And again, marketing for the other investors, he's taking an active role in doing that. But it's great when you go into these deals going, I know I'm going to make money. I don't know how much, and I don't know the time frame yet, but it's going to be there. At the end of the day, there's no way he can lose money on this deal at all.
It's definitely, like we talked about at the very beginning, active versus passive investing. I mean, your performing note is truly passive. You buy it, the money just keeps coming in monthly, and then years down the road, you can decide to sell it or whatever you want to do. I mean, if you're buying a non-performing, you can expect to put more time into it, more effort, but you're going to make a lot better returns. Yeah, probably, right? I mean, that's the goal, is to make stronger returns and profit. So it's just a matter of what you're looking to accomplish and, what your goals are. And that's why I love this. So many different strategies. And real fast, Kevin, Sydney was just asking, what's in it for the note seller? So you're saying, notes get resold. I mean, I could answer that, but what would you say to her?
Well, again, on the note sellers, the performing note might result from an investor who bought a non-performing note, got that note reworking again, seasoned it a little bit, and then turned around and sold it, much like rehabbing a property, right? The people who make money on rehabbing properties don't buy the best house in the neighborhood. They buy the broken house, right? With what? They're going to buy it as is. They've already calculated how much it's going to fix them to cost it up in both time and money. But after they do that, it's worth substantially more. Same thing. This could have been, or a non-performing note investor might have bought that broken note, got on their servicing company on it, got the note reworked, Now that people are making payments again, they proved that for 6 months or 12 months or whatever it is, and then added value to that note, turned around and sold it. So that could be one of the ways that that you see those notes being traded. You also have other investors who want to. They've already made enough money on certain items in their portfolio, and they see other opportunities, and they say, you know what, I'm just going to sell part of this portfolio to recapitalize because they've already made so much money on those, and then I'll just put the money to play at some additional deals. And I'm sure there's a percentage, like I think this one was, I think this person got into this original note, not my client, but the one who bought it. I think they paid probably way too much for that note. They didn't quite know what they were doing. And this had been through the foreclosure process. Because this was a judicial foreclosure, by the way, I could spend an hour and a half on this case study. It's got so many cool things in it. But you can go to the civil court records, which I did, and see the entire foreclosure process. So this guy's been fighting the foreclosure for over 2.5 years. And I think this note investor probably overplayed his hand, and just got into something. He just, man, if I could just get out. So for that guy, at least he got out. I don't know if he made money, lost money, or broke even. But we're not in the business of counting other people's money. We're counting on, what's in it for them and what's in it for us. So I guess it's a variety of reasons. One final one is you have bigger investors that buy in bulk. So when you buy in bulk, you get a bulk price, right? Where you might have paid 50 cents on the dollar. And then you're going to take that and mark it up 55 cents on the dollar and sell it to somebody else and just recapitalize in big pools. So there's several reasons right there for you. Okay. Now let me, all right, we're going to go through this, but this is awesome right here. This is a game changer. And I made this really simple for you guys. So what happened several months back, earlier this year, the American Rescue Plan Act was passed. And what that did was it set up funds of totaling $9 billion from the Treasury Department. And then they looked at all the various states. They tried to weigh out the degree of the problem. Remember all that forbearance stuff I went through? And I showed you 2.1 million loans. They know there's a problem there. Those people are not going to be able to come out and start paying again. So they're getting in front of it by funding up to $9 billion. So the money's already been allocated. And this time around, unlike what happened in 2008, this time around, every state has money allocated to them. Last time this happened, it was called hardest hit funds, and there was only 18 states plus Washington, D.C. This time, it's every state has money earmarked for it. And when I started going through this plan, I immediately recognized this is the offshoot of what used to be called hardest hit funds in the last go round when we had the market crash in 2008-9. And people made a ton of money on that. I track that every month. I go to the congressional reports and look at all that sort of stuff. So I immediately recognized all the way down to how they're telling them to build their websites is exactly what happened before. And I knew this thing was coming here. So the $9 billion's already been done. I tried to, instead of going to the internet, I took screenshots for you guys, but you can look it up. So Department of Treasury, Homeowner Assistance Fund, $9.9 billion. Allocated to the states. They have to submit their plan on how it's going to roll out. And now I've got this other website where you can see, this is a couple months old. I looked at the new one today, but you can see that some are in the phase of submitting the plan. Some have already got their plan approved. The states have to get their plan approved by the Treasury Department here. Okay. So the states are in that process. All right. Why is this important to you guys? Okay. Here's a typical example. This is forward thinking, everybody. All of these states are still waiting to hear back from the Treasury right now. Okay, I think there's only one state, Alabama, that is actually doing the funding right now. So typical example here, you got a property worth $100,000 because property values have gone up, right? Through all of this crisis, property values have still gone up. They still owe 200 payments. So they paid 160 payments, ran into the crisis, weren't able to pay, and they got forbearance plans, and now they lost a job or whatever it is. You can just imagine how many some odd million people are in this scenario. Their unpaid balance is low because really the property values have just gone up. So they owe 30 grand on the property, but they also owe taxes because they haven't been paying their property taxes, and they have unpaid payments of about $25,000. Okay, so that's about $600-700 a month for 3 years or so. So I used industry numbers for this to make sense for you on a typical deal. So when you're coming in and buying a non-performing note like this, you're looking at the collateral certainly, but you're also looking at the unpaid balance of this loan. You don't know if you're ever going to get paid back. You might have to foreclose and that sort of thing. So you're looking at a combination of a couple numbers that we use different ratios on, but you're also looking at that arrearage account. And that's what all those accumulation of unpaid payments are. They're called an arrearage account. So I'm looking at that as well, because the way this works is this. Let's say you come in and you buy this note, this non-performing note. They haven't made a payment in over 3 years. You come in and you buy this for $20,000. Very realistic number based upon everything I've given you here, which is all realistic numbers. So you come in and you invest $20,000 for this non-performing note. You got to get those property taxes paid, because otherwise you're potentially going to be wiped out, because that is a most senior lien in every state in the United States. So we know we have to address that immediately. And we're looking at those unpaid payments. So you buy this, you're locked in, and now you start implementing your exit strategies. Before you bought this, you started thinking through the exit strategies. The first exit strategy that you want to implement is this new government program. Okay, so let's say that this was in Alabama. There's Alabama's website. Alabama will pay up to $50,000 to catch somebody up on their loan. $50,000. Okay, Michigan's at $25,000, so each state's going to be a little bit different. So they apply for assistance. How do they apply? They can do it right online. There's phone numbers now that people can call. And the basic qualifications, if you read through all of this, which I have, is the borrowers can't be making more than 150% of the average income in their zip code. Well, if they're in, a 60, 70, 80, 90, $100,000 home, they're not making 150% of it. So it's basically, and again, in lower price bands, in California, you might run into that situation where the person's not qualified because they make too much money. So in areas that I invest in, Midwest, Southeast, it's almost a given that they're going to meet that qualification. So they apply online or on phone, and 90 days later, the state says, okay, we got to, make the county whole here. So the state's going to pay those $2,000 in property taxes, which is great, because now you don't have to pay it. But that doesn't solve the person's mortgage problem. That solves the county's, uncollected tax problem, but we still have to deal with that mortgage problem. So what they'll do is say, all right, our plan allows for up to $50,000, but they only owe you $25,000 here. Okay, so we paid the taxes. They owe you $25,000. That would prevent a foreclosure. Why? Because they're catching them up on the loan. That's what this program does. If you read through there, that's exactly what this program is designed to do. So they will pay you $25,000. Now the taxes have been paid. Now their loan has been caught up. They pay that directly to you. They wire that directly to your account. They don't send it to the borrower and say, hey, don't forget to send that along. They send that directly to you. It doesn't matter what you paid for the note. You only paid $20,000 for this note. 90 days later, you get $25,000 back. And the state says, you know what, they still need a little help. We'll pay their next 12 monthly payments as well. So say this payments are $600 a month. It's another $7,200. How much money do you have in this deal at this point? Nothing. You had $20,000 in. You got $25,000 back. Plus you're getting payments for the next 12 months paid directly from the state into your account, because they still owe 200 payments. And guess what? After they make the 12, they still owe you another 188 payments.
Wow. The first thing I think of, Kevin, is people are always saying, man, the banks get bailed out. The banks always get bailed out. How come we never get bailed out? Well, this is kind of showing you how to take advantage of what the banks take advantage of.
Yeah. This is when this was back in 2008.
Wow.
They tried this for the first time. They funded 18 states for 8.2 billion. So more funding in this, more states. And that program, I mean, we had deals like this all the time. I mean, people purposely started looking for non-performing loans, even though, you know, part of you is like, well, I want to be a passive investor, but then you see this and you're like, well, wait a minute, maybe I could be a little active, because you can outsource this. I mean, it's all on the website. Now, these websites have brochures, they have phone numbers, they did a much better job this time around of making it easier for people to apply. I think they've taken the lessons from the last one and said, okay, we made a lot of mistakes there, let's fix that up, let's make it tighter. And I think that's what's going to happen this time. And the money will be spent, everybody. The money will be spent. So that's a whole other conversation of, well, who's ultimately, yes, the taxpayers ultimately paying for it. But you know what? The money's been allocated. The money's been spent. In fact, any money that goes unspent within a time frame here, which is still being determined on a state-by-state basis, by the way, any money unspent goes back to the Treasury Department. That's how they had it last time. And what governor, what senator of what state wants to be known as the one that you still had $100 million that could have helped people and you guys didn't have your act together and spend it? Nobody. So
Right.
They're much more proficient on this one. What I've observed is, again, they're telling these states all the way down to their website, you have to have this. It has to read like this. It has to be easier. We had, and when they did this program back in 2009 in Florida, we were given $1 billion in Florida last go around, and they only spent half of it in the first 2 years. There was no phone number even for people to call. They had to get on the website. Well, guess what? Not everybody, you know, is adapted that. Not everybody was doing that. So this time around, phone numbers and everything else, you know, as you can, I just took one little screenshot there of Alabama's, but you get the idea. But imagine that. I mean, that's where it gets, just because you can't even calculate your return at that point. You have no money in the deal, and you're still collecting all those payments. And yes, by the way, if this, let's say you bought this note and you collected 12 payments from the state, and then you said, I'll sell a partial of these payments. Could you do that? Sure, you can do that. You don't have to, you know, but you could. So real estate, you can typically make money one go around on it. Notes, there's multiple. And I'm telling you, when this, you can see why I'm not sharing this with the note investor world. I'm sharing it with my clients because I don't know of anybody else in the business teaching what I just showed you guys.
It's awesome, man. I mean, that's
it will as the word leaks out.
Yeah, that's a game changer, though. I mean, that's it kind of takes all the risk away when the government's guaranteeing to pay you.
Yeah. And it's the borrower. The only thing you have to do is get that borrower to fill out the application. And you think, well, that's going to be easy. Well, a lot of people are skeptical, you know, and so you, through your servicing company, here's the website, here's the flyer, call them up, verify it. You do it directly with them. I'm not involved. And that's how it works. I've had people ask me about, well, what about land contracts and manufactured homes? It's on a state-by-state basis, but if you go to Michigan's website, it's very clearly land contracts, fine, manufactured homes, fine, everything. Yeah.
Very good. Oh, well, I love it, Kevin. I know I got you for an hour here, and we're coming up to the minute mark. So, so how can anybody get a hold of you? I mean, like I said, you're on Private Money Club, so they can definitely get a hold of you on there. So anybody on Private Money Club, just go to the lending section, notes, all of Kevin's links and everything are on there. And then on the screen, it looks like just Kevin@kevinshortel.com.
Yeah, most of your clients who have come over and are working with me as well, it just started with a phone call. You know, it just says, call me up. Sure. We'll schedule a call. We'll talk about the business, talk about what I can do to help you, and really go from there. And that's been very successul and very easy way to do it. So
awesome. Well, I just have a couple questions. If you got a couple more minutes there. First off, Chris was asking, he definitely wants to work with you and learn more. But he's asking where your book is for sale, where you can get a copy of your book.
Amazon.
Okay.
Amazon.com. You can search under my name or my brand, which is Real Estate Without Renters, which is the name of the book too. Yeah.
I did put the link over in the comments too. So that's a direct link right to Amazon. I just want to see if there's any other place, but if Amazon's the way to go.
No, just Amazon. Yeah.
All right. Do you see when the Fed lowers rates and and everything like that? What has the interest rate been doing while the Fed is lowering rates? Is it related or important? So I guess I don't know what she's exactly trying to ask, but does that make sense to you?
Well, I mean, interest rates in general are, if anything, they're going to start to go up. If you're talking specifically mortgage rates, there's been a slight uptick on that too. In our side of the note business, we're not as sensitive to that at all because a lot of the inventory we deal with are loans that are, maybe older and still had adjustable rates, or maybe it was one of the examples I showed you, somebody bought a house and sold with seller financing, which is not regulated the same way. So some of these seller finance notes are already written at 8-9% interest. So we don't, aren't as rate sensitive, if that's what you were referring to there. The other big thing is if property values do go down, how much you paid for something is going to be important. And when we buy these notes that are well seasoned, they have good equity in them. I mean, on that $100,000 house where the guy put $15,000 down, was only a $30,000 note. What's the odd that house is going to drop from 100 grand down to 30,000? I mean, if that happens, then we're all in a bunch of stuff, anyway. So it could drop to 90,000 or 80,000. My client was only in it for 20 grand, so buying right's a big part of it.
Yeah, perfect. Do interest rates stay the same? Everything stays the same when the note changes hands?
Yeah, when you buy a note, you buy the note as is. So if somebody is currently paying 8% interest on their note, you can't come in and say, hey, I own the note now and 8% is not cutting it for me. We're going to bump it up to 10%. You can't do that. You're buying the note as is. You're buying a contract, right? You're buying that note and the contract. You're buying it as is. But interest rate that they pay is not the same as yield for the investor because I buy at a discount. So if they owe $50,000 and they're paying 8%, but I pay $30,000 for that same income stream, I'm not just getting 8%. I'm getting more now because I bought the same number of payments for less than that unpaid balance. So my yield might jump up to 11% in that example. The borrower is still paying, that 8%. It's just I paid less for the investment.
Right.
That's how you get your yields up.
Are you allowed to assist borrowers with the paperwork? I assume in that last
paperwork for the, yeah, I assumed it was. I assumed it was too. You can't fill it out, but you can assist them. But I think what you're going to find this time around is they're going to be a lot more user friendly. Once again, everything I've looked at on the various states, and I tried not to hit every a detail on it with you, just cut to the chase for you guys. But believe me, as I said, this is something I've been looking at for months and months already. So I know it very, very well. They're making it much more user friendly because the Treasury didn't like it last time where states like Florida just weren't getting the money out there. And that's a challenge. So this time around, I don't think that people will need too much of your assistance with that. They're essentially going to show, that they live in the house, that they own the house. It shows the basic paperwork of that. They're probably going to have some statement that they have been hit hard financially as a result of COVID. Well, most everybody has in some way, and that they don't make over, again, 150% of what the average person makes in the area. So if they pass that threshold, the approval then just comes down to, well, how much do we need to pay to prevent a foreclosure? What's the arrearage account, all that sort of stuff.
Yeah, and it goes back to, just real estate and investing in general, especially in the real estate world, is just relationships and communication. And I mean, just if you come across that, hey, I'm helping you do this program so you can stay in your home, you don't get a foreclosure on your record, you're taking advantage of a program that the government's providing to you, and just keep it a very positive. I mean, they're going to be more than happy to learn and listen to you. And I mean, if they can stay in their home, I mean, that's a huge thing. So
I know what I'm going to do is when you buy a loan, anytime the ownership of the loan changes and anytime the servicing company changes, there's 2 federally required letters that go out. So the servicing, if I board it with a new servicing company, or I keep it with the same servicing company, there's still a letter that goes out showing that my company's the new note owner. That's federally required. So you have to send that letter to them. And why not just instruct your servicing company, hey, insert this brochure in there too. Make sure they get that. And the brochure would be about the program. Because if you go to the various states' websites, they have downloadable one-page forms that outline what these programs are. That's going to be your marketing piece. You don't have to even recreate anything. You can hire also, if that doesn't work, you can hire a door knocker. Okay, there's sites like We Go Look. You can hire a door knocker for 50 to 75 bucks. That'll physically go out to the property, hand deliver, the envelope.
All right, Kevin. Well, this has been awesome, my friend. I want to respect everyone's time. We're at the hour mark. Just in closing here, I know you work with people on many different levels. Can you just give an example of like some of the different ways you help the various clients and what they're trying to do? Ethan was just asking kind of what your programs or services look like. So just an overall, and then they can schedule a call to get more specific.
Yeah, sure. What I do, I spend most of my time. In fact, I already told my 2 o'clock appointment that I was going to be late. Like I anticipated that earlier today, but he's waiting on hold for me on Zoom because we're going to go over some deals that he's looking at buying. So I work with people on a one-on-one basis, which is really, it's been amazing the results that people get because that's what they need. I don't outsource it. You're working with me directly, not somebody who works for me and doesn't have the experience. It's me. You book the time. We structure it on Zoom just like this. We can get online. We can look at documents. We can go. I take people through the whole process of that. But I also have all of my educational materials online as well. Those are available, 24/7 on the website, and it's very, very detailed and very well laid out. There's probably 30 hours worth of videos on there that are all structured in educational format, like a 3-day training, essentially, plus some bonus materials on there. And I've had a lot of people who tried, it kind of depends upon where you are, what your background is, perhaps, and risk tolerance and everything else. I've had some people try and just, work, can I just consult? And then they end up going, you know what, I need some background. I need to know more about the thing and get the full material because, it's the price points and things that I have for this business. It's ridiculously low. And I hear that all the time from people who know me in the business. You're not charging enough. And here's the other thing, everybody, I'm limited, right? At some point in time, I'm not going to be able to take more clients on because I just believe that people want to work with the expert. They want to work with me. And I've only got so many hours in a day as well. But right now we're chugging along and it's going great.
That's awesome, man. Well, I've had nothing but positive feedback and experiences from our clients that have been working with you. So thank you very much for that. And always caring for the Money School, Money Multiplier community. Yeah. One last thing. What was the government website about the assistance programs?
Oh, you want that, do you? See? Let's see if I have a link there. Hang on a second.
They asked twice in the comments, so then they're itching for it.
Yeah, this is the one that, and I'll send it in the chat, if that's okay.
Yeah, absolutely.
So I think that, yeah. So that's the one that's going to show you all about the fund, and then there'll be links there to other websites and such. But that's the main one right from the Treasury Department. You can read about it and what they do.
So it's if you're just watching, don't see the chat box, just home.treasury.gov, followed by a bunch of stuff. So it's on the Treasury website, that's the coronavirus assistance. So maybe you can Google it that way. But all right, Kevin. Well, thank you very much. I put the link over to schedule a call with Kevin. If for some reason the link's not working or you need to access this afterwards, just email me, snaggy@chrisnaugle.com, or reach out to me like always, and I'll connect you with Kevin directly. A lot of times we do email introductions that way, and it works out very well also. So Kevin, thank you very much for everything you're doing and staying on top of all the new programs and all the changes. And I have a feeling that, I know we've been talking about this a lot, but there's going to be a lot of foreclosures. There's going to be a lot of changes in the real estate market, coming over the next year, 18 months and beyond. So get ready for it, get prepared. And I think there's going to be a lot of opportunities especially with all these programs coming out in the note space, take advantage of that and really get your money working and make a lot of money. So that's awesome, man. So thank you. I will see you on January 23rd or the 24th. I don't know if you're on Saturday or Sunday during the 3-day, but we'll see you then. And have a great start to the year, Kevin. Thanks so much.
Sounds good. Thanks,
See you guys
everybody.
soon.
Thanks, Steve.